Hey, it's Matt with PriceActionTradingSystem.com, and it's Wednesday. It's March 11th, and this will be our chart lesson for today. And another big sell-off today, another wild day. Really, it was all downhill today. We went a little bit flat here at the open, the regular session open. You can see the blue. This is all in the overnight. You may not be able to see this real fine line here, but that's the open yesterday afternoon. So this is all the overnight session. When it turns white, that's the regular session, and it closes here at 2 o'clock. So I just make it blue after 2 o'clock because this white area is the main trading period. I usually start at 7, but I like to keep this at 8:30 at the regular session just so I know where that opens. Um, there was a huge gap today. We didn't even prices attempted to try to come back here and fill it, but this trend channel just was too much. We had a break and moved to a new low, and I believe that we were just shy of making a new low, overnight low. Chart seems to be freezing up there. There we go. We actually got down to 20. Well, let's just see where we got down to today. We got down to right at 2,700, maybe 2,702. I think we were slightly below that before. Yeah, 26.95. So we didn't quite make a new low yet from this was the low on the big sell-off during the overnight the same day. This was when we had the big sell-off on Monday that I missed, and during the overnight we shot a little bit lower before we bounced really strongly. And you can see today that we came real close to matching that low, but we didn't quite get there. And what was really interesting about this today was we rallied from here to here 50 points in like 10 minutes. I mean, it's just crazy. And, I can't remember when the market moved. I'm sure it has, but it's a rare occasion that the market moves 50 points in 10 minutes or less. It just doesn't do that very often. So this is a crazy market. But in the big picture, this is a spike in channel. We spiked down, went into this channel, and most of the price action was just fluctuating back and forth at the midline here. You can see this is the midline running right down through here, and there's even a spike in channel, a tighter one within the big channel here. And notice how we spiked down, and then we just kind of went sideways in this channel. Prices were coming back to this trend line here, but they'd turn down every time. And eventually we broke lower here and dropped on down. And pretty much, it's not quite a measured move, but if you drop that on down there and you play with this one, you find out your midline is probably slightly higher, like right in there or something. So we were actually getting some overshoots here, it looks like, but originally I played it down here. It didn't really matter. Once we dropped down, it was well after 2 o'clock. So regardless of how you saw it, that's what it was there. Again, what you have to do to trade this really is you have to drop down into these lower time periods. And you can see I really stopped following the market much after 10 o'clock today. A few times I came back in and I'd draw some shorter term, stuff here. But I was pretty much done really early this morning. So, but that's kind of how I saw it. What I wanted to do today, I've got 2 or 3 people that are asking me daily about second entries, and so I'm going to show you a few second entries here on the chart, just so, to make it easy for those people. Just so it's very understandable. Notice that we're working down here. I'm just picking a spot here on the chart. We made a new low right here. It's lower than this swing. So this is a new low. So when we finally make this low and start climbing here, the count is 0. And notice we're working up and you break lower right there. That's your first entry. If prices keep going down and don't make a higher low right here, it's still your first entry unless it either makes a new low or it makes a higher low. And we actually made a higher low right here. It breaks lower and then instantly turns up. So when it turns down and breaks lower the second time, right here, that is a second entry short. So that's a perfect, look at that signal bar, perfect signal bar. That's a great second entry short right there with the trend. Trend is down. So that's what a second entry looks like. If you're working to the downside. If you're working up, like, let's come back here. We got a little rally right here. So we made a high here, but it's still lower than that one, so there's no new high. So really you got let's just start right here. There's your first new high on this little uptrend here. So you pull back, and this is the first bar that broke higher than this bar. And yes, you have to count the stems. So it's not a break higher until it breaks at the high of that bar, which the high of that bar, I just put the line on, is 27.51.75. So when prices break above the high of that bar right there, that's a first entry. And notice we never corrected. We went on and made a new high, so count 0 again. So you start correcting. There's your first break. When prices break above the high of this bar right here, that's a first entry. But it goes all the way up and makes a new high. So all you got was a first entry. It pulls back. Counts 0 right here. It pulls back. When it breaks above this bar, and yes, it has to count the stem, so it's right there. First entry. And you never get a second entry there. Its first entry is all the way up, and then suddenly it drops down. And you actually made a new low. It probably made it on this bar and then turned up. So there's a first, actually notice that new high. And there's a first entry when it broke higher right there. And it's dropping down, dropping down, dropping down, dropping down. And it broke higher again right here. That's a second entry long right there. Really, you're trending down now, so you're probably looking for shorts. But that's a second entry long. And then it keeps going lower here. That's a third entry long. That's the third time it broke lower. And then, guess what? It makes a new high. So the count is 0 again to the upside. You're dropping down. There's the first break higher when it breaks right above that bar right there. First entry long. Starts down. When it breaks higher right there, second entry long. Boom, off it goes. Makes a new high right there. And then it makes a double top. So a double top can count either way. So that's either, you could count that as a first entry or this is a first entry. You can count it either way. And so if you count that as a new high, then first entry, and then there's a little second entry long right there. Obviously that's not a very good setup. So I'd probably count that as a new high, a first entry, and then we'll see what the next second entry looks like. And then there's the second entry right there. Boom. And you may take that trade because there's almost a triple bottom across there too. The trend is still down. It's not a great setup, but it's not a bad second entry, and it would have worked. But for the count to the downside, now you got a new low here. It's lower than that low, so the count's 0. When it broke lower right there, that's a first entry, but it drops on down. You never get anything more than a first entry, so now you got a new low. You're just going sideways here. Don't try to count that. Just skip it. Actually, right here, you got a new low where it broke lower, and it moves up. So that's a first entry short right there. And it just drops on down. You got a new low, so the count's 0. Well, when it breaks lower right there, that's a first entry short. But if you got a newer low, it's lower than that one, so the count's 0. First entry short again right there. And then you get a second entry short right there because we didn't make a new low. Notice that low? When it broke lower right there, first entry. It actually ticks lower again before it starts to go higher. So now it ticks lower right there. That's a second entry short. That double bottom, you can count that as a new low. So that's a third entry short right there. And then it runs up here and you get a fourth entry short because it's never made a new low. Actually, I take that back because since if you count that as a double bottom as a new low, then it did make a new low there. So the count's 0 right there. runs back up, and when it breaks lower right there, that's a first entry short. It runs down. It doesn't make a new low, so it corrects right there. So when it breaks lower again, which is right below this bar right here, that's a second entry short. It fails quickly and runs back up. And there's actually a second entry long right here. Notice that new high counts 0 off the top, and it comes down, and when it breaks higher above that bar right there, that's the first entry. And so it starts working lower again without making a new high. So when it breaks higher again, that's a second entry. It runs all the way up to make a new high, so the count's 0 again. So it's working down, breaks higher, gives you a first entry, works lower, it breaks higher again right there and gives you a second entry that fails instantly and turns down. Oops. And then you get a third entry long right there, comes up, drops down, fourth entry long right there, drops down, fifth entry long right there, but hey, now it makes a new high. It's higher than that one, so counts 0 again. First entry right there, pull back, second entry long when it breaks higher right there, and now it makes a new high because it's higher than that one. First entry, second entry, and then the bottom falls out right there. Now if you're counting off the lows, you got a new low right here because it's lower than that one. So first entry short, and then it tries to go higher. Second entry short right there, and that was a good second entry short. It's not a very good, well, actually that was a good setup because that's a fairly bearish bar. It's off the high, so there's a good second entry short right there. Runs down here, but guess what? Now it's got a new low because it's lower than that swing low right there. So the count's 0. Works up, first entry. You got a higher low right there, so when it breaks lower, that's another second entry short. But it makes a new low right there. It's lower than that one, just barely, but it is. So first entry, but it makes a new low. Turns back up, and you get another first entry, but it makes a new low. So another first entry right there, and then guess what? A second entry short right there, and then it makes a new low, first entry, second entry. So I hope that's clear on how to count first and second entries and thirds and fourths and however many it goes before it makes a new high or low and starts the count over. And you can always have a count going off both sides. What I tell people that are inexperienced is the only thing you need to be worrying about is it going down or up. If it's going down, you should be counting off these lows looking for second entries. Don't worry about counting off the other side because that's going to be too complicated for you if you're new at this. Yeah, I know you'll think you're smarter than everybody else and that you can do it, but you'll just confuse yourself. So just trust me. Don't worry about counting. The only side you should count off early on is with the trend. So if the trend's down, you're counting off the lows, looking for second entry shorts. If the trend's up, you're counting off the highs, looking for second entry longs. It's that simple, really. And again, sorry, I'm having a little trouble with my voice here today. Again, when you count these bars, when it comes to Japanese candlesticks, I know there's a whole trading system designed around Japanese candlesticks. I don't believe in that. I don't care about that. That means nothing to me. Only reason we use candlesticks is for the visual effect. Notice how easy it is to just glance at this chart and tell which bars are bearish, which bars are neutral, and which bars are bullish. It's simple. If it's real green, it's real bullish. If it's got a little body where the red or green in the middle of two stems, you know it's neutral. And if it's real red, you know it's bearish. So as a price action trader, we're very visual traders, and you want to just be able to glance at your chart and know what your signal bars look like in just a blink. Or if you're using regular bars, you'd have to study your bar a minute and figure out which side. The opening's usually on the left, and then you just got a bar, and then you got a close that's on the left, and it takes a few minutes. Where this, you can just glance at it. So that's the only reason we use Japanese candlesticks. When it comes to a break, higher or lower, we use the whole thing, including the stems. So Don't get confused by bodies and stems, any of that stuff. All this, the only reason we use these type bars is for visual. So the stem is part of the bar. So if it has to break above the high on this bar, it's got to break above the body there. And just make this real big so it's real simple to see. Um, just is this in case of this one right here. If we were waiting on a break lower, we're not looking at the middle of the bar there because that's all this counts, all that stem. So we're looking for the break above, below that whole thing right there. And if it was breaking higher, it would have to break above the very top up here. So make sure that's clear because I get that question almost daily. So yes, you count the whole bar. The only time I do not look at the whole bar is when I'm drawing trend lines. And that's the next thing I'm going to talk about real quickly here. When I draw my trend lines, generally you start your trend, just to give you this little trend right here, you'll start your trend at the very high using the stems and everything, the very high of the start, and you draw it down and you draw it. This is when I will use the closes. You draw it through the first swing right there, and you do use the closes on that. That's the only time you'll ever do that. And the only reason in the beginning I didn't do that. But I begin to notice that you get a better trend line by using the closes and not worrying about the stems. Although you do have to start at the very high, and if you're starting off the bottom, you have to start at the very low. But use the closes, and you'll get a better trend line. And then again, let's just erase this one for now. Let me make this bigger. There's not a big stem on that one right there on that first swing, so it's really doesn't make much difference there. But if this stem was sticking way up here, I'd still draw it right off that close right there. And then you want to copy that and drag it over to the other side. And you can see it's coming right down through there. And it should fit really nicely. If it doesn't, let's say it fits off this one, but yet this one's sticking way down underneath, and then this next one's way up here, then either your trend line's not right, or maybe you don't have this side in the right place or whatever. In this case, the market was just getting weaker to the down move was weakening, so it wasn't quite as steep. This is really too steep. A good trend is going to be about a 45-degree angle, and that's much closer to a 45-degree angle going down there. So what this is, there's another little spike in channel here too, inside that other one, and you can see that right across there. And now if I copy this one and drag it over, it should fit pretty well on the other side. And you can see it does fit pretty well. We did get a little overshoot right there, and then again right here, and that led to a little bit of a reversal. But you can see most every time prices touch down here, they're reversed. And so the whole idea is the down moves should reverse near this line and go back up, or the up moves, well, these are down moves, so they should hit the downward side and reverse back to the upside. And when you get back to the upside, they should hit the line and turn back down again. And that's pretty much what happens. We're at the low, we go to the high, we turn down, we go to the low, we turn up, we go to the high, we turn down, we go to the low, we turn up. When we get back to the high, we turn back down. When we get back to the low, we turn back up. And that's the way it should work. And if your lines are not doing that, then something is probably suspect on the way you're drawing your trend lines. So I hope that's helpful. That's pretty much all I'm going to talk about today. Again, in case you didn't catch yesterday, with all this volatility and so many trades and the market just being absolutely wild right now, I'm going to spend more time talking about things like this rather than trying to go through 50 or 60 trades and rush through them and so forth. This was really interesting today, though. Again, when we hit this low right here, and we've had some other bounces that are similar to that, but notice this low was at 2:25:18 my time. So basically 2:25 Central Standard Time. We hit a low of 27:03, and we went straight up. I'd say all the way to this high. We made this high at 2:42. So maybe less than 15 minutes, we went from 27:03 to 27:57. So 54 points in less than 15 minutes. You know, I've seen days where 54 points would be a monster move for the whole day. And it looks like nothing but a blip here. And if you back out, it's just a little blip of a correction and a huge downtrend. So that just shows you how crazy these days are. So like I said before, don't feel obligated to have to trade. I know when you're new, that excitement about trading and wanting to trade every moment of every day, and don't let that suck you in. You know, you may just want to turn on your simulator and sim trade it. You may want to take vacation this week until this is over. The margin is getting higher, and there are points where they will stop trading. And that's, you know, one of the beauties of why we like to day trade versus swing trading and not carrying trades overnight is it's so much safer. And that's why the margin is generally so much cheaper for a day trader, because it's safer. You don't have to worry about the market closing on you at a certain time and then opening up and gapping crazily and stopping you out and you losing a fortune or losing your whole account. Just to give you an example of what I'm talking about. Let's go over to what happened Monday. If you were carrying trades overnight, especially if you were trading the regular session. If you traded the regular session, prices closed right here last Friday. Well, they would have opened up way down here during the regular session. They still opened up way down here even on the overnight session. So let me, you know, it doesn't look like much right there, but if you look at this, okay, this thing closed 29.64 1/4 and opened at 29.16. So you can do the math there, and that's almost 50 points. So most of you couldn't, you know, most small traders couldn't, you know, they couldn't stand a 54-point gap on them, especially if they were long, which you might have been right here. You might have been long going into this close. And if that thing drops on you that far, unless you're short, you're in a world of hurt. And if it drops, and let's say you're trading the regular one at so 29.63 and it opens at 28.21. I mean, that's 100 and something point drop. And you know, the average trader couldn't sustain that. You would get a margin call. Not only would you get stopped out, you'd get a margin call and you know money. So it would not be pretty. It'd be the end of your trading probably, and you'd have to write a check that you wouldn't want to write either. And hopefully it wouldn't ruin you, bankrupt you. So I mean that's happened to traders in the past. There's been, you know, there's history's littered with big traders that exact same thing happened to them. And that's the beauty of day trading, is we usually don't have that problem. But when you get swings this large from high to low, they can and do halt trading. So there's some number. I mean, I'm not sure what they are off the top of my head. Most of your brokers will notify you if they're getting close to them or send out emails and things. But you should know where those circuit breakers are, and if they halt trading, and then suddenly it opens again, it could gap on you just like that. So this is a dangerous market. It's it's great for making a lot of good quick money, but it can, if you're not careful and you don't know what you're doing, you can lose a lot of quick money. So I don't want to scare anybody, but I want people to, you know, some people are not quite aware of what can and does happen to traders in markets like this. So never trade without a safety stop. And you know, always take that hit if you have to, because as bad as that hit may seem at the moment, usually by hanging on or watching it move a little further, giving a little more room, you just increase the pain until finally you can't take it, and that'll usually be down here. And as soon as you exit, then you get a 50-point rally. So you're better off just to take your hit. Live to fight another day is my motto. Always make sure you can live to trade another day, because the next day you'll have a lot of pressure relieved off of you. You won't be so down on yourself. You won't be fighting back at the market. All those silly things, and most of you, if you've done it, been trading long enough or traded live, you know exactly what I'm talking about. And those are the things you have to conquer to be a successful, profitable trader. So anyway, I think that's enough for today. Um, we'll be back again tomorrow. Tomorrow, I'll wrap up our week. No chart lessons on Fridays. We'll talk about something else again tomorrow. But I hope that was helpful on the second entries and on the break of the bars, where they have to break and where the break has to be and what constitutes a break. You count the whole bar in these things. Japanese candlesticks mean nothing other than their visual appeal to us. If you want to learn about Japanese candlesticks and see if there's any real value to all that stuff, feel free to. My opinion is I don't care anything about it. I'm just using them because of their visual appeal to me. It makes it real simple to look and say, hey, is my signal bar bearish? Is this a bullish trend? I mean, it's real easy to see. Just like right here, it's real easy to see that's real bearish all the way down. You're starting to get a little buying right there, it drops, you get a little more, and then finally, we're going the other way. And you can tell all the corrections are mostly little red bars. It just allows you to see the trend, and especially your signal bars, like right here, that is a nice, huge bearish signal bar. But if you were using the regular type bars, you'd have to glance at that for a couple seconds to say, okay, we opened here, we traded up to here, and we closed way down here. It just takes a little longer. I mean, I'm sure you could probably train your eye to see it quicker than I could probably see it, while I'm not used to looking at them. But why go to all that trouble when you can use these candlesticks and I can glance in 1 second and know that closed on its bottom, and it traded way down from where it opened. It's real simple and real visual. So anyway, I'm going to wrap it up. We'll be back again to do it tomorrow. I'll find something else I want to talk about tomorrow that should be helpful to everybody. And we may do this for a little while until the market gets back to a more normal pace where it's a normal number of trades, and it's just not such a daunting task to go through and talk about all the trades. And again, if you have a trade you want to ask me about, feel free to email me. Just do it within reason, and we'll go from there. Anyway, I'm going to wrap it up. We'll be back again to do it tomorrow and wrap up our week. This is Mac with PriceActionTradingSystem.com, and we'll see you next time.